where profits are large enough, compliance signals can be muted for a long time, until the story becomes public and expensive. Marketing sells comfort, investing demands clarity, and the cost of mistakes is often socialized across shareholders, reputation, and we deal with it later. Hello everyone. Today's episode is uncomfortable but extremely useful if you are an investor. We are going to talk about the Jeffrey Epstein case. And right away a disclaimer, we are not going to dig into the details of the crimes. And this is definitely not true crime entertainment. But the Epstein story has another layer, a financial one. And for an investor, that layer matters more than yet another market forecast, because this isn't only a story about a criminal. It's a story about how premium financial institutions and major brands behave when on one side of the scale you have reputation and rules, and on the other profits from an elite client. And the most uncomfortable part is this: a lot of what we know here isn't rumors. Over many years, this story accumulated documentation, internal signals, investigations, court filings, settlements. This wasn't nobody knew, it was closer to enough people knew, enough to ask questions. But as usually happens, those questions lost to big money. My goal is to highlight one investment truth. In 2026, investors don't win where the brand is the loudest. They win where the structure is the clearest, the rules are understandable, and the logic of returns is transparent. And that's exactly why more and more capital is moving into private financing. When you're dealing with the real counterparties and real contracts, not with brands built on image, obscurity, and something very ugly incentive behind the screen. Today, I want to break down three things: what this story actually shows investors about how big money work in the real world, why major brands and beautiful, expensive offices are not guaranteed of protection, and why in a world where trust in the top layers is cracking, demand grows for models where you can see the deal, see the borrower, and understand where the income actually comes from. Because after stories like this, people start paying attention to how structures work, and they start valuing direct, transparent agreements. Alright, let's go. Facts without conspiracy. What an investor needs to understand. Let's separate emotion from mechanics. The Epstein story is horrifying for human reasons, but for an investor, it matters for a different reason. It shows how incentives works. The key fact that many people don't want to accept. This wasn't like nobody knew, this was we choose to look away from certain facts. In stories like this, the most important thing is the behavior of the system. There is questions how the system behaves when risk becomes obvious, when red flags appears inside an organization, when internal department starts sending signals. And the real question is, what the business do next? Does it stop? Or does it keep going, as long as it's profitable? And in Epstein case, we can clearly see how major players ignore the signals long past the point where any reasonable person would have asked, why are we still doing business with him? Let me anchor a few points. No theories, no rumors, only what's been documented in investigations, court records, and official reporting. Epstein was convicted in 2008 and registered as a sex offender. That wasn't a secret, it was a public legal status, and yet major banks continued servicing him and related entities for years after that conviction. Investigations described how compliance teams saw red flags, filled reports, recommended exiting, but the business side ignored those signals. JP Morgan reportedly kept Epstein as a client for roughly 15 years, including after his guilty plea, despite internal compliance warning. In 2023, JP Morgan agreed to pay $290 million to Epstein alleged victims in a class action settlement that accused the banks of ignoring clear signs of human trafficking. Deutsche Bank, which took Epstein after his relationship with JP Morgan ended, paid $75 million in a separate settlement and was additionally fined $150 million by regulators for significant insufficient control procedures. Compliance analysts have written directly, Epstein's crimes were not a secret. He was a convicted offender and known predator. Yet banks moved his money for years. Advisors protected his assets, and suspicious activity reports didn't stop this machine. These facts show something very uncomfortable about the system. Where profits are large enough, compliance signals can be muted for a long time until the story becomes public and expensive. And for an investor, that leads to one harsh conclusion. A premium brand is not a guarantee of honesty and transparency. It guarantees only the scale of the stakes and the power of incentive. The core lesson: big institutions play by their own rules. People love a comforting fairy tale. It's a big bang, so they must have shell-proof protection. They have a compliance, procedures, regulations, but reality works differently. What happens inside the system when red flags appears? In large institutions, you often see the same pattern. Step 1. Risk becomes visible. Not necessarily through headlines, sometimes through formal status, investigations, internal reports, or unusual transaction patterns. In Epstein case, there is an important detail. After 2008, he carried a public legal status as a convicted sex offender. That wasn't a gossip, it was a fact, and yet financial relationships continued for years. Step 2. Compliance turns on the red light. Warnings appear, recommendations to exit, restrictions, suspicious activity reports. In court filings and major reports about JP Morgan, there are references to internal discussions of red flags and lawsuits alleged the banks ignore obvious signals. Step 3. Here is an epilogue where you see the true culture, because from that point it's not the policy that decides, it's incentives. Compliance is responsible for risk on paper. The business side is responsible for profits in reality, and the cost of mistakes is often socialized across shareholders, reputation, and we deal with it later. What the business does in practice and why? If we say it in a cold clinical way, business often acts by his own formula. As long as risk does not turn into an immediate fine, lawsuit or headline, the relationship survives. That's not an excuse, that's a diagnosis. Compliance can see and document risk, but the business side often keeps going until risk becomes more expensive than profit right now. And only when external pressure activates courts, regulators, publicity, the system starts dealing with it. I don't want to say that big corporations are evil. The main point is what trap an investor falls into when buying a sign instead of a mechanics. An adult investor thinks if it's a big brand, it's a complex incentive system. And I'm obligated to understand who actually pays the price when things go wrong. Because in cases like this, the cost of failure is usually distributed like this. Reputation gets repaired with PR, fines, and settlements, and paid from shareholder pockets. And individual decisions dissolves between processes and policies. So the question, how will they behave with my money, isn't emotional, is the most rational question you can ask. Why this breaks investor trust in the top layer? And now we get to the logic that millions of people feels, even if they don't articulate it. If a major instruction can tolerate toxic risk for years because it's profitable, then any investor should ask one simple question. In a disputed situation with my money, will they protect me or will they protect their profits? Premium institutions often sell an image: we're reliable, we're the last line of defense, we'll check everything. And to be fair, a lot of companies over $100 million in revenue operate on the same template, spend millions on marketing to sell peace of mind. But investors need to remember, marketing sells comfort, investing demands clarity. Where trust moves, from gray systems to clear, transparent deals. Now here's the key turn. When trust in the top layer erodes, it doesn't disappear, it flows downward toward structures with less magic and more specifics. People start looking for models where you don't have to blindly trust the brand. You can see who the borrower is, where the money goes, the terms, the interest rate, the income is understandable. Loan, interest, investor payments, and risk is defined upfront, not hidden behind reputation and fine print. That's exactly why we have seen growth in areas like private crediting. This is no longer a niche. It's a full layer of the credit market. According to Alternative Credit Council and Houlihan Looking, global private credit reached 3.5 trillion assets under management by the end of 2024. And 2024 direct lending volume reached almost 600 billion. This growth isn't hope for price appreciation, it's expansion of contract-based lending with cash flow mechanics, crowd lending, loan-based crowdfunding. European Securities and Markets Authority reported that in 2024, 4.25 billion was raised through crowdfunding service providers in the EU, and 58% of that volume was loan-based, meaning loan, interest, repayment. Again, obligation, not hype. P2P marketplace lending. Even the public market version shows the same dynamics. Funding Circle reported that in first half 2025, it originated 1.1 billion in loans, plus 21 year-over-year. Again, contractual cash flow, not asset repricing. And more broadly, structures where returns are generated not by price going up, but by payments under an obligation. Which brings us to a bigger point. Crowd lending isn't an alternative to banks. It's an evolution of how capital behaves when trust in the top layer becomes expensive. Why private crediting can outlast most banks and funds. And this isn't moralizing theory. We have already watched the same pattern play out even among the biggest, most reliable, most media protected brands. Institutions that ask investors to believe the image while operating by very different rules inside. FTX, well-known crypto exchange, the symbol of new finance, that was in March 2024. A US court sentenced founder Sam Bankman to 25 years for fraud. The Department of Justice described how billions in customer deposits were misused through affiliated entities outside the promised rules. Wirecard, Europe's fintech's pride. In 2020, Wirecard admitted that 1.9 billion in reported cash likely never existed, and the company collapsed. Theranos, a unicorn with magazine covers and celebrities investors. Founder Elizabeth Holmes was sentenced to more than 11 years for frauding investors. The promised technology didn't match the reality, but it was sold as a revolution. Credit Suisse, Swiss regulator FINMA found serious supervisory failures. This wasn't one bad trade, but systematic weaknesses in risk governance and organizational structure, leading to frozen and closed funds and major client losses. Wells Fargo, a household name bank, the SEC described practices where millions of accounts were opened without customer authorization to hit internal metrics and bonuses, followed by penalties and investigations. That is why the one who makes the loudest promises is not the winner. The winner are the structures built for transparency and control, clear deals, predictable obligations, verifiable risk, not a cult of brand and beautiful stories. Because private credits is not a bet on a market mood, it's a bet on economics. Business needs capital, business pays interest, investor earns income. Not because people believe, because there is an obligation. But there is an adult part. P2P is not a magic and not a risk-free. It's a real market with a real risk. Credit risk, liquidity risk, platform operational risk. And this is exactly why I draw a parallel to the Epstein case, because that case shows what can exist behind large institutions. Incentives, disorientations, image management, and something really substitution with messaging. I'm not saying those institutions will disappear. They have billions, they will remain. And I'm not here to play moral judge, I'm simply showing the mechanics as it is. And my conclusion is straightforward. An investor is not guaranteed to win just because the institution is big. If the baseline incentive is survive at any cost and put the institution first, then you as an investor have one job: stop buying the label, start evaluating the structures. The obvious conclusion why I choose the P2P crowd lending niche. 8Lens sits at the intersection of the two realities. Investors want a transparent cash flow and clear risk rules. Small and mid-sized businesses need capital, but it's not always convenient or even possible to get it through a bank. We operate in the space where the market is maturing. P2P crypto crowd lending as a format that makes credit deals digitized, transparent, and most important, predictable and understandable for the investor. In the market, we build the model around collateral and the discipline of repayment obligations, not around pretty promises. We believe trust in 2026 is created not by a brand name, but by written rules you can't bypass. And we deliberately use the language many marketers avoid. There is a risk. It just needs a shape, clear boundaries, and a logical structure. That's why our formula is simple. Not there are no risk here, but the risk is readable. And readable risk is the line between competent investing and blind faith in nice slogans. From morals to practice, how an investor should act after all the big scandal. Here are 7 questions I recommend asking about any instrument, a bank, a fund, a token, a platform. Who pays the return? What holds the deal together if growth stops? What is the collateral or protection? What does the best scenario look like? How does exit, term, liquidity actually work? What rights do you have on the paper? Is communication transparent? And do you get the real answers? If the answers are unclear, it's not investing, it's a trustfulness. Let's summarize everything. The most valuable asset isn't yield. It's the right not to play someone else's game. The Epstein case demonstrates one thing. When the stakes are high, some institutions will go all the way and stay at dirty stories as long as it's profitable for them. And for an investor, the main conclusion is simple. A brand is not a protection. Protection is the deal, structure, your rights, and transparency. That's why more and more people are moving away from the model. I give my money to the system, and I hope the people at the top are honest. Toward the model, I choose clear deals. I see how the return is generated. I understand the risk, and I control my allocations. And that's exactly where P2P crowd lending, especially in a Web3 format, becomes one of the most logical answers of your time. If you want to see how it works in practice, go to 8Lens, explore the projects, ask questions, read the terms, and most important, think like an investor. Not who do you trust, But what do I understand here and what protects my contribution? Write in the comments what matters more to you, brand or structure. If you want to understand how it works in practice, visit our website where all of our processes are described. And you can also join our Telegram channel where we share a lot of useful information. That's all for today. Thank you for being with me until the end. See you next time.